Well, hello aspirants. A very warm welcome to Oliveboard. This is Rohan Dange, your faculty for the day. And today's session is going to be around non-banking financial companies. So it's a quite a new topic, quite an important topic. So once again, welcome all of you for our renewed series on RBI. Let's begin. So as you can see, I deal with finance. Now, what are NBFCs? NBFC is a company incorporated as per the Companies Act 2013. So this is something that you cannot forget. You have to keep it in mind. Okay. So it is a company which is incorporated as per the Companies Act 2013. Okay. It is governed by both the Ministry of Corporate Affairs and RBI. The second bit of information here, which is very important, is that it is governed by both, which is the Ministry of Corporate Affairs and the RBI. Now, though the NBFC provides financial services, it is different from banks in many ways. Now, how is it different from banks in many ways? It cannot accept public deposits by allowing people to open savings or current accounts. See, in general, how does the business of bank works? The banks mobilize funds through the depositors who deposit their money with the bank. So that becomes a liability for the bank because the bank will have to return that money by loading up a rate of interest on that to the people, to the depositors. But obviously, the depositors want to keep the money with the bank on a long term, majorly speaking, right? Then the bank will roll out that money in the market. That will become the asset of the bank. Roll out that money in the market as a loan, right? So there are depositors of the bank. Their money, depositors' money, is going to be used by the bank to roll out that money in the market to give out to the creditors. That becomes an asset for the bank because the creditors will return the money, right, by loading up some interest on that. So this is the business of the banks, right? Now NBFC is a very typical business where the banks simply don't accept public deposits. Okay, but does that mean that the NBFCs do not receive any deposits? Because otherwise, if they don't receive any deposits, then how are they going to materialize, or how are they going to, what you can see, how are they going to make arrangements for funds to be given out in the form of loans? So NBFCs can receive deposits under any arrangement or scheme in one lump sum or regular contributions or some other similar method. Okay. One more difference that NBFC has with the banks is that it cannot issue checks and drafts which are drawn on itself. The NBFC cannot issue checks or drafts drawn on itself, right? NBFCs provide credit and loans at the micro level. There are a lot of micro level entrepreneurs in India. There is a lot of requirement for micro level credit in India, but because of the lack of penetration of the banking network, or because of the lack of financial literacy amongst the people at the datum of the pyramid, at the bottom of the pyramid, it becomes difficult for this creditor and banking business to come together. Now this gap, this funding gap that exists in the Indian society especially, can be definitely plugged by using the network of the NBFCs. So the main job of NBFCs, or the main objective of the NBFCs, is to ensure accessibility of credit to small, medium scale and enterprises, because it is generally these MSMEs, that is medium, small and medium scale enterprises, especially micro and medium scale small. It means the health of the micro and medium small scale sector in India is indicative of the health of the entire economy. And if this sector is financially healthy, then that will lead to a virtuous cycle wherein people will have more jobs, they will consume more, the demand will be higher, and the private sector will be compelled to produce higher, right? But this virtuous cycle is not triggered off when liquidity crunch besets the micro and small scale industries. So to plug this gap, or to act as a catalyzing factor, NBFCs come into the picture, right? Because then they are seen as agencies which can help the micro and small scale enterprises get access to valuable credit at the right time, at the right rate. Okay. Now, what are the conditions to register as an NBFC? Okay. So the first condition is obviously that the business should be registered as a company under the Companies Act 1956 or 2013. And the minimum capital, which is net owned fund requirement, is 2 crore rupees. Now again, these are the kind of 2 markers which can be asked in the exam. This is very factual. So I hope you're taking down your notes. And once you take down your notes, keep revising them over and over again. Do not forget to revise. Okay, that's the golden rule. So the principal business of the applicant who is applying for a license should be financial activities. That should be the principal business. That means if your principal business as an organization is telecom or airlines, then it is not possible to register your NBFC. Okay. So if the financial flow of the business is more than 50% of the total capital asset, then the company can get NBFC registration. Okay. Now that is self-explanatory. And it should have at least one director from the financial field or a senior banker as a director. The CIBIL records, basically the credit rating agency, should what you can say, should furnish a clean record for the NBFC. That means there should be no case or case history of defaults, financial defaults or financial frauds. Now, what are the types of NBFCs? There are various types of NBFCs in India. So once the NBFC licenses are given by the RBI, they can be registered as insurance companies. Quite naturally, if you are an insurance company like an LIC, GIC, or any private sector insurance company, you are going to be regulated by IRDA, Insurance Regulatory and Development Authority. Then there are housing finance companies. They are regulated by the National Housing Bank, right? Then you have the stock broking companies. They are obviously regulated by SEBI, which is Securities and Exchange Board of India. There are merchant banking companies. They are regulated by SEBI. Merchant banking companies are different from scheduled commercial banks. Okay. Mutual funds, of course, SEBI is the regulator here. Venture capital companies, SEBI is the regulatory authority here as well. Then there are companies running collective investment schemes. Here again, SEBI is the regulator. Then there are chit fund companies also. These are regulated by Chit Fund Act and the respective state governments. Then there are Nidhi companies also. They are regulated by the Ministry of Corporate Affairs. Now, everything that I mentioned and everything that I have put on the screen is very important from examination point of view, because two markers can be asked regarding regulatory authorities, right? Like for example, they will ask you who is the regulatory authority for Nidhi companies. This is a two marker. If you've read this, it's an easy one for you, right? So it is regulated by the Ministry of Corporate Affairs. Like for example, uh, uh, which organization is the regulatory authority for venture capital companies? Now, when such a question is asked, you might be tempted to feel that RBI could be the correct answer, but the correct answer is SEBI, right? So take a good note of this particular slide. It can definitely fetch you 1 or 2 marks. These are low hanging fruits and you cannot afford to miss them in a highly competitive environment like RBI Grade B. Okay. There are other types of NBFCs also, like and they can be classified and categorized on the under two broad heads, depending on the nature of their activity or depending on the basis of deposits. So the NBFCs which are based on deposits are broadly classified as, the first one is NBFC D. They are basically known as deposit taking NBFCs. Then there are NBFC ND, which is non-deposit taking NBFCs. Now, at the beginning of the lecture, I told you that the NBFCs do not accept deposits, right? But which deposits were we talking about? We were talking about the deposits of the public. But there are certain shareholders, there are certain people who are the what you can say, the investors in NBFCs. They can put deposits in NBFCs. Those kind of NBFCs are called as deposit taking NBFCs. And completely contrarian to that, there is a opposite type of an NBFC which is known as non-deposit taking NBFC. Okay. Further, they are subcategorized into two parts: systemically important NBFC ND and others NBFC ND. So there are certain, what do you understand by system? It's not systematically, by the way. I beg your pardon for that. That's a spelling error. It's systemically important NBFC ND. Now, what do you understand by systemically important NBFC ND? Systemically means something which is important for the system to survive. Like for example, there are systemically important banks in India. There are three systemically important banks in India. The first one being ICICI, the second one being HDFC, and the third one, of course, being the public bank, the public giant, that is SBI, right? So these are big banks. That means they are too big to fail, and therefore they are systemically important. They're important for the financial systems to remain healthy. Likewise, you have systemically important NBFC ND, which is non-deposit taking NBFC. And then there are other NBFCs also, right? So this is the classification based on deposits. So deposit accepting NBFC meaning they must get themselves registered with RBI as per the provisions of the RBI Act 1934. They need a certificate of registration from the RBI, and then there are certain additional guidelines and regulations prescribed by the RBI. There are non-deposit accepting NBFCs also. So these non-deposit accepting NBFCs, they also need to get registered themselves. And the only difference is additional guidelines do not apply to them, right? So now the non-deposit accepting NBFCs can be of many types. Primary business is of financing physical assets. Physical assets like real estate, like gold. So if you want to invest in real estate, or if you want to invest in gold, if you want to invest in farming land, then you can approach an asset finance company for the provisioning of loan. There is also something called as an investment company. Okay. Now what's an investment company? A financial institution engaged in the acquisition of securities as its principal business. So if you want to acquire securities or treasury bills, if you want to invest in the market, and that investment is of a very big ticket size. For example, like right now Nika IPO was released, and if you wanted to invest, say suppose 50 crores in Nika IPO, then you can actually approach an investment company, and then they will help you in buying those securities. Then there is obviously the loan company. Now what's a loan company and what's its principal business? It's to make loans or advances for any venture other than its own. Okay, but does not include an asset finance company. So a loan company can be any company. Suppose I am a watchmaker, but I am also a loan company, right? One of my sister subsidiaries or sister concerns is a loan company. So I will not give out loans for to the enterprises who are watchmaking or who manufacture watches. Okay, so that is a loan company, and it does not include an asset finance company. An asset finance company is definitely different from a loan company. Okay, so there is a difference. So these are all non-deposit accepting NBFCs. Apart from that, in that list you can also add infrastructure finance company. So as the name suggests, at least 75% of its loan extensions should be given to the infrastructure sector. Okay. And its net owned funds should be minimum 300 crores. So it should have a very, very big size. Its credit rating should not be less than A, and its what you can say CRAR should be of 15%. Okay. So this was on the basis of the demand, what you can say, when you talk about the non-deposit accepting NBFCs, these are asset finance companies, investment companies, loan companies, and infrastructure finance company. Based on the business activities, again there are different types of NBFCs like investment and credit company, infrastructure company, which we have seen, mortgage guarantee companies, non-operative financial holding company, and credit company. So these are based on what you can say their activities. This classification is based on their activities, right? Moving forward, you can also talk about microfinance company, systemically important core investment companies, infrastructure debt fund, NBFC, NBFC account aggregator, NBFC peer-to-peer lending platforms, housing finance companies, and so on and so forth. So very recently, RBI has decided to merge the three NBFCs, that is asset company, investment company, and loan company, into one named NBFC Investment. So today, NBFC Investment comprises of asset company, investment company, and loan company. So this is the most important bit, because this is a recent, what you can say, recent change. So therefore, quite likely to be asked in the exam. Okay. Now we'll take a look at these types one by one. Now what is the investment and credit company? So here basically it focuses on asset finance, whereby loans or advances are given for any activity other than its own. That's an investment and credit company. Then there is infrastructure finance company, as the name suggests. Here the loans are given for infrastructure. At least 75% of all the loans are given for infrastructure. It should have a minimum net owned fund of rupees 300 crores and a CRAR of 15%. There is another which goes by the name mortgage guarantee company. So mortgage finance company is an NBFC whose at least 90% of the business turnover is mortgage guarantee business, or at least 90% of the gross income is from mortgage guarantee business. Okay, so these are the two alternative criteria for a mortgage guarantee company. I hope you know what's a mortgage. Mortgage is something against which a loan is extended. Okay, so this is the kind of company which guarantees the mortgage. Okay, so here what are the two alternative criteria? That at least 90% of the business turnover of the microfinance company is mortgage guarantee business, then you can be called as a mortgage guarantee company. Or at least 90% of the gross income of the microfinance company is from the mortgage guarantee business, right? So these are the two alternative criteria, and its net owned fund should be 100 crores. For infrastructure company it was 300 crores. For mortgage guarantee company it is how much? It is rupees 100 crores. Then there is NBFC, non-operative financial holding company. So it is a type of NBFC which will hold a bank as well as other financial companies which are regulated by RBI or the other financial sector regulators to the extent allowed under the applicable regulatory prescriptions. Okay, moving forward, what's a microfinance company? This is the kind of question which is generally asked in the exam. So these are the companies that perform the functions as similar to banks. Loans are offered by microfinance companies to various small businesses that do not have access to the formal banking channels and are not eligible for availing loans. Okay, so they are not eligible for availing loans. This is one important thing that you must register about the microfinance company. So they have to maintain 85% of qualifying assets at all times. Okay, so whatever assets that they have declared, they have to hold them. At least 85% of the assets have to be held at all times. The loans given by MFC to a borrower having annual income in the rural sector not exceeding 1,25,000. In the urban and semi-urban areas not exceeding rupees 2 lakh. Okay, so this is the upper limit. And the amount of loan shall not exceed rupees 75,000 in the first cycle and rupees 1,25,000 in the subsequent cycles. Also, the tenure of the loan should not be less than 24 months. So this is some of the criteria that you should remember. So this is a matter of your memory. Please note it down and please keep revising it almost every second day. Also, the total indebtedness of the borrower should not exceed rupees 1,25,000. The loan to be provided is to be provided without collateral. That means without any mortgage. Okay. That means without any security. Because obviously if you're giving a loan to a very, what you can say, to a person who is financially very weak, he or she is not in a position to provide a collateral for that loan, right? And the repayment of the loan, very importantly, is at the choice of the borrower. That means the loan can be repayable on a weekly, fortnightly, or even on a monthly basis. That is the choice which is what you can say strictly which belongs to the borrower. So the borrower will decide whether he or she wants to settle the loan on a weekly basis, on a fortnightly basis, or on a monthly basis, right? There are NBFC factors. Now what is NBFC factor? It is a different type of NBFC which is engaged in the principal business of factoring, right? So basically it is centered around the factoring business, right? And that factoring business should aggregate at least 50% of this total assets. Okay, and also income acquired from factoring business should be at least 50% of the gross income, right? So factoring business you have to remember. Then there are systemically important core investment companies. So when you talk about systemically important core investment companies, CIC, it holds not less than 90% of its total assets as an investment in equity. Equity means shares of a particular given company or preference shares or debt or loans in group companies, right? For example, Reliance. If you're holding 50% of your equity in Reliance, then that can be what you can say financed by core investment company. But what is a core investment company? Any company which holds not less than 90% of its total assets as investment in equity. That means whatever assets that a core investment company has, it should be in equity or preference shares and debt or loans in group companies. Okay, that means a sister company of Tata which holds 90% of its total assets in the form of preference shares and equity of Tata, that can qualify as a core investment company. Okay, and then it can qualify as a NBFC, and its investment in the equity shares in group companies form at least 60% of its total assets, right? That means 60% It's investment in equity shares in group companies. So there are Tata group companies. So suppose you're talking about, I'm just for understanding purposes, let's talk about Tata Finance. So if Tata Finance has at least 60% of its assets in the group company, that is Tata Industries, then it can qualify as a core investment company, right? And it does not invest in shares, debts, or loans in group companies. That means Tata will not extend, that core investment company of the Tatas will not extend loans or will not invest in shares or loans in its own group companies. Okay. So, what most important thing that you should know here is that the core investment companies do accept public funds, right? We have learned till now that NBFCs don't accept deposits, but there's an exception. The core investment companies, they do accept public funds. So, infrastructure debt fund, what is that? Because it's a different type. It is not the infrastructure company, it is infrastructure debt fund. So it is a specific fund created for infrastructure under an NBFC. That NBFC is called as an infrastructure debt fund NBFC, and it is a non-deposit taking NBFC that deals in the facilitation of long-term debt into an infrastructure sector. So it is basically traces the financial resources either through an issue of rupee or dollar denominated bonds of 5 years. Now, currency denominated bonds of 5 years. This is what you have to remember. It could be rupee or dollar denominated, right? So it is a debt fund, correct? And these are specifically called as infrastructure debt fund NBFCs, and the maturity period is of 5 years. Then there is an NBFC account aggregator. It provides data of several users and shifts their financial needs to various financial organizations. So the account aggregators basically involves providing customers financial information in a very concise manner, in a retrievable manner. Okay. Then there is NBFC peer-to-peer lending platforms. Here you are just provided a platform by an NBFC to bring lenders and borrowers together by using a digital platform, and it provides an opportunity for investors to diversify their portfolio. Okay, so it is just a platform where lenders and borrowers are brought together. That is an NBFC peer-to-peer lending platform. Then finally you have the housing finance company. So that is a form of NBFC with the principal business of, as the name suggests, the financing of acquisition of construction of houses. And who regulates that? As I've told you in the previous slides, they're regulated by the Reserve Bank of India. So housing finance company cannot commence the business without obtaining a certificate of registration from the RBI. So that is about NBFC account aggregator, peer-to-peer lending platforms, and housing finance companies. Also remember, investment finance company is different from investment debt fund. Okay, and both are types of NBFCs, right? So I hope that this lecture was beneficial for you. Wherever possible, please uh, pause the lecture and make your own notes. But I hope this preliminary information regarding NBFCs has come in, what you can say, will help you directly in answering questions in the exam. So till the time we meet next, this is Rohan Dange signing off. Thank you and take care.